So we all know that stock prices go up and down every single trading day, and this is the way that it's always been. But what a lot of us aren't realizing is that the dividend yield is also going up and down every single trading day as well because of the way that it works. So in this video, I'll teach you how the dividend yield works, and I'll also teach you how to calculate it on your own. Because honestly, it is worth looking into the dividend yield. It's just not really as important as we tend to think it is. Because when I first started investing, I thought that if you saw a 5% dividend yield, that meant that you always got paid 5% in dividends no matter when you were investing in that company. And once you discover what the dividend yield actually represents, it's quite a bit different than what a lot of us think. The dividend yield is just the current percentage of money that you can make based on what the company's paying out in dividends relative to their exact current stock price. So basically the way it works is if you see a dividend yield of 5% and you happen to invest $10,000, then $10,000 at that 5% rate would mean that you'd make $500 per year in dividends. But that's also assuming that you're investing all that money at the exact same time. Because if you took that same $10,000 and you invested it a month later, the dividend yield could be completely different. It could be higher or lower, and that's all dependent on the stock price, because as the stock price goes up or down, the dividend yield is also going to fluctuate with it. So if you happen to be looking into a company that you want to invest in and you see that they have a current dividend yield of 5%, then do not assume that that 5% is always going to stay the same. Because as the stock price goes up and down every single day, it is going to fluctuate the dividend yield as well. And also keep in mind that if the company you're looking into changes how much they're paying out in dividends, that can significantly change the dividend yield. Because let's say that a company is paying out $5 per year a share, and then all of a sudden they drop it to $2.50 a share, that can be a significant change to the dividend yield. So just keep that in mind as well. Now you do need to understand that dividends are always paid out per share. So for instance, if you have $1,000 to invest and you're looking into a company that costs $100 a share, then at that point you can only buy 10 shares of that company with your $1,000. Now, if the company you invested in happens to pay $2 per share, then obviously with your 10 shares, you'll make $20 per year in dividends, and that happens to be a 2% dividend yield. But let's say that you decided to wait to invest in that company, and later down the road, their share price ended up going down to $50 per share, and you still wanted to invest that $1,000. Now, at this point, if you put $1,000 in at $50 a share, then you'd end up with 20 shares. And if they're still paying out the $2 in dividends per year, then $2 in dividends at 20 shares means that you're going to make $40 in dividends per year, which happens to be a 4% yield because the yield goes up as the share price goes down. So obviously, if you only have $1,000 to invest and that specific company's share price happens to go down, then that would mean you could buy more shares for the same amount of money that you have to invest. And because dividends are paid out per share, you will be making more money per share because you can buy them at a better value when they're lower. Now, if you want to calculate the dividend yield, all you have to do is take the current dividend payout per year and divide it by the current share price, and that is it. So if a company pays out $1 per share in dividends every year and the current share price is $10, then just take 1 and divide it by 10, and then that'll give you your dividend yield, which is a 10% dividend yield in this case. And please be aware that dividends are never guaranteed because any company out there can always cut back their dividends. They can either reduce them or they can cut them out completely, and you don't have any control over this. So even if you do all the research in the world, there's still a chance that it can happen, but obviously there are companies out there that are significantly better than others in terms of being reliable on paying their dividends no matter what's happening in the economy. Now, if you are new to investing, I do have an affiliate link for Robinhood in the description below where they'll actually give you a free share just for signing up. So definitely check them out if you have an interest. Now, if you just happen to find this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So if you do have an interest in this type of content, feel free to subscribe. But thank you for watching this video. Have a great day.